When the holidays start to feel a bit repetitive, reach for a Sprite Winter Spiced Cranberry and put your twist on tradition. A bold cranberry and winter spice flavor fusion, Sprite Winter Spiced Cranberry is a refreshing way to shake things up this sipping season. And only for a limited time. Sprite. Obey your thirst.
This episode is brought to you by Indeed. You're ready to move your business forward, but first, you need to find the right team. Start your search with Indeed-sponsored jobs. It can help you reach qualified candidates fast, ensuring your listing is the first one they see. According to Indeed data, sponsored jobs are 90% more likely to report a hire than non-sponsored jobs. See the results for yourself. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Good morning, guys, and welcome to another episode of the Financial Freedom Podcast. I'm really delighted about today's guest. It's a sponsored episode, Jonathan Spitz, and he is head of capital formation at Lightstone, and we're going to hear all about what he does, what Lightstone is, how he helps clients, which clients he helps, and where we are headed economically, geopolitically, and into 2026. Jonathan, welcome.
Thanks for having me. Looking forward to the conversation.
Yeah, and briefly introduce yourself. You've got quite a number of experience in the financial industry, and we'll dive into the questions.
Sure. Yeah. My background, I've been in the real estate business for over a decade now at this point. I've worked really in all facets of the business, from lending to acquisitions, brief stint in brokerage when I first got out of college. And for the last 6 years, I've worked on the private equity, on the fundraising side. So raising capital for private real estate vehicles, everything from funds to individual deals, working with investors of all shapes and sizes, working with investors I've worked with a lot of physicians, so many physicians that have never invested in real estate before, and just trying to understand the business more broadly, to very sophisticated family offices and wealth managers. I think that has brought me to our most recent experience now in really leading our fundraising team at Lightstone. Obviously, Lightstone is a company we've been around for over 40 years, but we've really mostly been a family office, meaning, and what I mean by that is we manage about 12 billion in assets. I would say less than 10% of that has been capitalized using outside capital sources. So most of the acquisitions that we've done have been really using our own balance sheet. And now we're really extending that to individual investors that are interested in private real estate. And so it's a really interesting, and we can talk more about it, but yeah, that's what I'm up to these days and what we're doing at Lightstone.
What a fantastic introduction. And we'll dive into the questions, into the content. And so first thing is, what type of investors, archetype, persona do people come to Lightstone to invest with, and how do you help them?
I'd say, again, we have investors of they run the experience spectrum, for lack of a better words. Most investors that we work with, they have day jobs, right? They typically are not professional investors. Not always. Sometimes they are. But most of the time we're working with investors physicians, right? They're in medicine and they're working most of the time, or they own a business, or they're approaching retirement. And most of the time when we're speaking with investors, it's usually they're looking for one of two things, or really one of three things, really. One, it's income to supplement what they do on a day-to-day. So looking more specifically for tax efficient income. So that is one of the benefits of investing in real estate, is that not only can you generate higher yields of 6%, 7%, 8%, but you can get depreciation benefits that make that cash flow significantly more tax efficient. Another reason that people are looking at private real estate is maybe just growth, right? Looking for returns that maybe they're not able to achieve in the public markets without taking on significant volatility risk, right? Or not that's necessarily can be viewed as a risk, and private real estate can provide that. As an example, you can get whatever low digits internal rates of return on your investment. And the third reason I would say is really just more diversification and something to reduce volatility within a broader portfolio. So usually, oftentimes we'll get that question, should I invest in public REITs or private REITs or private real estate? It's, for us, my answer is always just, it's an and, not an or, right? Like, you absolutely should have public market exposure. You should have private market exposure. To the extent really just depends on who you are as an investor. And that's always my answer it's always up. It's really that's the thing in being this business for 6 years. I've worked with investors and everybody's risk tolerance and what makes them comfortable is very different. Some people want all of their investments to be in private assets where the liquidity is not important to them, right? And that's the thing when you're investing in private markets, you may not have liquidity for 3, 4, 5 years. For some people, that doesn't matter. Some people, liquidity really matters. So this is very much a personal journey. And part of our job at Lightstone is when we're having a discovery call is to uncover what is it that you're looking for? What is important to you? Most importantly, is liquidity important? Is cash flow important? Are you looking for growth, long-term appreciation? What is it that you're looking for? Stability. And then we can uncover, is what we do a good fit for you? Because at the end of the day, when we're working with investors, if you decide to make an investment with Lightstone or any private real estate manager, immediately that becomes a long-term partnership because you're typically going to be in a deal for 3, 4, 5 years. And we want to make sure that you feel comfortable with the investment that you made, right? And so that discovery process is really important for us when we're working with people.
Yeah, I love that, how you described all of the different aspects and archetypes of the people that come to invest with you. The other thing about investing with asset managers and family offices is it's all a relationship. So if people listening to this podcast and they're interested in Lightstone, what is the unique distinguishing feature that separates Lightstone from other family offices, other funds, and to really hone down on one's niche?
Yeah, I think the biggest distinction at Lightstone is just the amount of capital that we co-invest alongside our investors. If you rewind the clock, obviously real estate's been a really challenging place to invest for the last 3 years. And we can talk about why. Obviously, higher interest rates is a big part of that. But what you saw during this period is a lot of managers didn't make it. And when you really peel back the onion to understand why it was usually due to two things: experience and alignment. So a lot of managers that had only been investing coming out of the great financial crisis, they didn't know anything but a market that went up. And usually in a market like that where there's easy money, there's a lot of tailwinds, risk management can become a second or third as far as priority list, right? Or what's on the priority list. So for us, we've been investing for 40 years. So we've invested across multiple market cycles. We've gotten punched in the face in the great financial crisis. We've gotten hit on deals, right? And that made us a better manager for the next cycle. And so that we didn't make the same mistakes this time around. So I think experience and longevity is one of them. But secondly, it's just, again, the amount of capital that we co-invest in our deals and the level of alignment that we have, meaning that, as an example, we will always invest a minimum 20% in every deal that we bring to an investor. So we're always the largest investor in every deal we do. There are not many, if any, managers that can say that, right? Most managers invest anywhere between, let's call it 1% to 2%, maybe 5% at most of the total equity that is required in a deal. We're putting about anywhere between 5 and 10 times that amount. So what that says is, these are deals we are comfortable doing and putting that level of conviction in. Charlie Munger has a famous quote, and it's, "Show me the incentives and I'll show you the outcome." And I think this is a great example of that, right? Is that we're putting our money where our mouth is.
The next question I have for you is what are the requirements to invest with Lightstone? Is there a net worth or is there a minimum income? And you mentioned 3 to 5 year holding period.
Yeah. So investors generally need to be an accredited investor. So that's individuals that make at least $200,000 a year individually or $300,000 a year jointly, or they have at least $1 million in net worth. So that's the general threshold. So it's just being an accredited investor. And yeah, generally our deals are anywhere from 3 to 5 years in duration. So what the model that we're generally following, to put it simply, is what we would call a buy, fix, sell model. So what we're generally doing as it relates more specifically to multifamily, so apartment investing and industrial real estate, so think more warehouses and distribution centers. What we're generally doing is we buy an asset We are improving the operations of the property, the rent roll of the property, and the physical property itself, right? So operational and physical improvements to increase income. So now that business plan generally takes anywhere between 3 and 4 years. So we acquire the asset, 3 to 4 years to stabilize, to execute that business plan, and then stabilize the building. And then once we've created that value, we will look to sell, right, to other private capital or institutional capital that's looking for more stable cash flow, longer duration type of investment. So that's how, again, that's where we think the best risk-adjusted opportunities are in the market, where you can provide good, strong cash flow. You're not taking development risk. And I think that's I think the biggest thing that I've learned over this past cycle too, is and working with a lot of investors, a lot of people, I would say, underappreciate the risk that's in ground up development for whatever reason. I don't know why that is. So you look at, okay, you're going to build this brand new asset. It's great, but and I like development. I'm personally invested in it myself. So I believe in the strategy, but it is risky. So I think people sometimes really underappreciate the risk that goes to a development deal. It can be death by 1,000 cuts between pre-development risk, entitlement risk, construction risk, interest rate risk, lease up risk. Like, there's so many risks that you have to deal with along the way. And so what we believe in at Lightstone, at least at this juncture in the cycle, is we want to be buying existing assets that have good, strong cash flow with the ability to raise rents, increase that cash flow further and add value, but it's just a different risk profile altogether.
In Walmart Sue time was ticking away. Only a few nights left till the big holiday. But last-minute gifters had no need to worry. Walmart Express Delivery got their gifts in a hurry. From Nintendo to Nespresso and Lego flowers, they could check off their lists in as fast as an hour. All of Newville, East, West, South, and North could order gifts up until 5 p.m. on December 24th. So this holiday, just do as the Who's do. With gift delivery this fast, they all gasped. From Walmart? Who knew? Subject to availability, terms and fees apply.
Tito's Handmade Vodka is America's favorite vodka for a reason. From the first legal distillery in Texas, Tito's is 6 times distilled till it's just right. And naturally gluten-free, making it a high-quality spirit that mixes with just about anything. From the smoothest martinis to the best Bloody Marys. Tito's is known for giving back, teaming up with nonprofits to serve its communities and do good for dogs. Make your next cocktail with Tito's. Distilled and bottled by 5th Generation Inc., Austin, Texas. 40% alcohol by volume. Savor responsibly.
And the next question I have for you is, are multifamily and industrial the only real estate asset classes that Lightstone focuses on, or is there commercial, or are you looking into self-storage, data centers?
Yeah, good question. Data centers are a hot one, right? There's so many people. It's become a very competitive space and something we are looking at internally, but I would say not to the scale and size that where we're looking at multifamily and industrial. We've invested in a lot of different asset classes, everything from retail to industrial to life sciences to hotels. We own 5,100 hotel keys across the country, and hotels done very well over the last year or two. But yeah, I would say right now it's mostly multifamily and industrial is where we have the most conviction right now. But life sciences space, and for those that don't know, life sciences essentially is almost a hybrid of office and industrial that is specifically designed and retrofitted for lab space or like research facilities, right? So a lot of pharmaceutical companies, buildings that have clean rooms, maybe enhanced power for certain aspects of the business. But generally, you're dealing with more healthcare related, pharmaceutical research type of facilities. Now, this space is really distressed right now. And Lightstone, the way we've built our company over 40 years is investing when there's distress. And so that's something that we like right now, that we're starting to make very concentrated bets in. But I wouldn't say it's, again, an opportunity set that we're diving in head first at this point.
And where does, for those, just because it looks like the current real estate cycle started in 2020, and for people that are curious about commercial, is commercial dead with COVID and just work from home? Is commercial just not a great place, or is it going to come back?
Yeah. So I would say when you say commercial, to be more specific, I think you mean office, right?
Yeah.
And office valuations have just gotten absolutely crushed there. And what's really different about office is you have this work from home dynamic. So you have to think about, when you're looking at any real estate asset class, you have to understand like what's driving demand over not just the next quarter, but the next decade. And what's so tricky about office is like the supply demand picture has really shifted. Now the work from home, and like you and I right now, we're doing this digitally. You can do meetings this way, and many people can. I work remotely, at least partially, here in Tampa when we're based in New York City. And so like a lot of this is happening at scale. A lot of organizations are fully remote. And yes, there's been much more of a push to come back in the office, which is probably a good thing. But make no mistake about it, like supply demand calculus has changed. And so it's really tough to understand what, at least over the short term, what that means for valuations, cash flow, demand, and ultimately what rents people are willing to pay. And then to address your question more on like the cycle and where that's at, the way that we believe it is that what you really had is a prolonged cycle for most real estate assets that really lasted from about, let's call it 2012 to 2022, right? So you had about a 10, maybe 12, depending on where your clock starts. You had one of the most elongated bull markets in history. But what we've really been in now, really since they started raising interest rates in 2022, was you've now had about a 3-year bear market. And so what we believe at Lightstone is that we're actually at the beginning of a new bull market. But again, it's going to be different for every asset class. We're not saying it's a bull market for office right now. We're not saying it's necessarily a bull market for life sciences right now. What we do think, though, is that for asset classes like industrial and multifamily, what you have seen is valuations that have largely fallen 20 to 30%, depending on the market and the asset type and the quality of that investment. And so we think now is a good time to start coming back in, because if you think about what's caused this recession that we've been in, right? Interest rates went up 400 basis points. It's the largest interest rate increase in modern history, I think, total. Or at least it was the largest increase in the shortest amount of time. And now, as evidenced by, we're taping this right now on December 11th, and yesterday the Fed decided to reduce interest rates, right? And so over time, that should be more positive for real estate valuations. But what we're also seeing is the growth of rents, because again, you're also seeing because you've had higher interest rates, there's been no development activity either. And the demand's been strong. So that means you should see revenues and rents grow over time as well. So you have falling interest rates, rents that are starting to increase. And we think that's a really good backdrop for real estate as we look ahead.
Yeah, moving on to, because I love to talk about, one question is, you mentioned 6 to 8% returns on real estate. And is most people that get into real estate, because what I was thinking was real estate's gotten really hard to get into, valuations, and 6 to 8%, those are very modest gains. Are most of the gains made in real estate just basically in the wealth preservation and in the tax benefits? Is that the main reason, not really the gains?
Yeah, great question. So we do believe that we are moving into a cycle where more of the return will be based on the income you make as opposed to the appreciation. So it's funny, I had this chart that we looked at the other day. And if you look at the last 4 decades, 40 years, what you notice is that in 3 or 4 of those decades, income makes up more than 75% of the overall return you get in real estate. The one outlier was from 2010 to 2019. Why? Because interest rates were going continuously lower. So we do think that now appreciation won't play as heavy of a role in returns, right? But that doesn't mean that you can't still do well. If you invested in real estate in the 80s, 90s, 2000s, you still did incredibly well. But you're going to need more of your expected return is going to have to come from the income. And so now to go back to the first part of your question, which was, I think really what you're asking is, has all the strong returns already been made? And our answer to that is yes. So you're probably not going to see 20+% IRR type deals on value add deals where you're not doing that much work. And there were managers that were doing that in the previous cycle. You could hold something and maybe do very modest value add business plan, and you would get these eye-watering type of returns. And the reason for that was because cap rates, or the multiple people were willing to pay, was increasing all the time, and people would pay more for that asset. Now I heard Ryan Severino, he's a chief economist over at BGO Asset Management. He has this great term. He thinks this is going to be called the golden age of asset management. And I think that's largely what we believe as well, is that right now, this next cycle is going to be dictated, the outperformance will be dictated by those that know how to add value to the property, because the market's not just going to give it to you. You need to be able to manage an asset well. You need to be able to price your renovation budget accordingly. You need to be able to drive leasing and drive occupancy. And that's what we specialize in. We are a vertically integrated organization. We have in-house asset management, in-house property management. We have a 40-year track record. We have a 40-person investment team with specialists in industrial, multifamily, life sciences. But again, so you can still make good, and because valuations have fallen 20 to 30%, people are starting at much stronger cash flow yields. So yes, when I was talking about that 6 to 8%, that's just one component of the return. As an example, we have a deal right now where yes, investors are getting paid anywhere between 6.5% and 8.5% over 4 years, but our target IRR over 4 years is a 15%. So more of that expected return comes from the asset sale, but you're still being well compensated with cash flow in a tax efficient manner while we execute that business plan. Yeah, I think returns in general are going back to more of the 40-year average, but that still is, you can generate mid-teens type IRR without taking as much risk, because again, we're coming into the beginning of a new real estate cycle.
And what a wonderful way to conclude this episode is, you mentioned the golden age of the next bull run of the real estate cycle. What does that look like given interest rate volatility, and Jerome Powell's going to be out next year? We got President Trump, and he's a real estate guy. Geopolitical, just inflation. Where does all of that play if one were to look at it and plan accordingly?
Yeah, I think if I was looking at the decision that the Fed made yesterday, and they're cutting rates, I wouldn't expect rates going back to 0 or 1% like we've experienced for much of the last decade. I think that it's very unlikely that we go there. I think we're probably going to be in a stickier inflation type of environment, which means not necessarily that inflation is going back to 9 necessarily, but is it going to go back to 2% in short order? Probably not. The S&P right now, as we sit here today, is hovering around 7,000. It's not like we're not really in a very deflationary environment. We still have a lot of large fiscal deficits. For a lot of these reasons, interest rates will probably be structurally higher. And so what that means is that going forward is that, again, for this next bull run, again, what that's going to mean is that investors really need to be looking at, okay, what is the premium that I'm earning over wherever interest rates are? What cap rate am I buying deals at? Where, let's go in the pre-2020, people would pay a 4 cap or a 5 cap, like 4% cap rate on Class A multifamily. Like, people are doing that now still, but they're doing it with the expectation that they'll grow out of that, not necessarily that interest rates are going to go down and make their deal work for them. So I do think what instead of the multiple increasing, and that's what's creating value, what's going to drive value are the earnings on that multiple. And that's going to be driven by managers that know which asset classes to be in, what markets to be in, and then how are they creating that value through their underlying business plan. So it's very different than really what we saw a lot of the last cycle, which was that managers were doing that also, but then they were also really getting helped out by very favorable market backdrop, which we may have, but I wouldn't be underwriting with the expectation that multiples are going to continue expanding from where we are right now.
Really fascinating conversation, and I think the audience will really benefit from your insight. And how can people connect with you and reach out more to find more about Lightstone and get more information?
Yeah, so you can visit our website, lightstonedirect.com. You can also email me. My email is jspitz, JSPITZ @lightstonedirect.com. And again, like I've been working with physicians and just individual investors for over 6 years now. So if anyone's just wants to dive a little bit deeper into the topics that I talked about today and just curious about the sector in general, feel free to shoot me an email. Happy to talk. Otherwise, if you go to lightstonedirect.com, we'll be putting out a lot of educational content to keep people informed with our views on the market and what we're thinking.
Excellent. Thanks so much for coming on. And I really enjoyed this conversation, and keep up the great work.
Absolutely. Thanks, Dr. Lou. I appreciate you having me, and it was a great conversation.